What's up, YouTube? It's Joe Catapaglia, sitting on the couch trying to make some money investing in fractional real estate online, as usual. Today, I'm going to talk a little bit about a little bit different. I'm not going to focus on a single property. I'm going to talk to you about a market there where there are several properties available. That's called the Quad Cities. Lofty's got 10 listings on there. I'm really only focused on 9 of them because one is a commercial property that actually hasn't closed yet. And I think it's not, it's much easier to compare all the others, and we'll do that. But first, I'm going to talk about the market in general. I think this is probably going to take me a couple separate videos to go over, go through the market, tell you some of the data that I've looked up so far, and then I'll probably do individual property videos that are just a little bit shorter when I jump into each one and see like, hey, is this one that I actually want to put some money into? But so for today, we're going to start off. One of the reasons that I'm looking at this, I don't know if you guys watch this other YouTube channel. It's maybe not quite as popular as mine, but they just put out this video about cash flow hotspots, and really honed in on this area. I don't know, I think that was just a day ago, and it's kind of interesting because one of the things that I've always avoided a lot of the Rust Belt, and I'm not sure that we still call it the Rust Belt, but I don't know what else to call that area. But I've always avoided it because it tends to have shrinking populations. Even though you have high rent to price ratios, which means you have a pretty good yield, it's often really difficult a lot to manage properties profitably because with a shrinking population, there's a lot of competition. It tends to be more vacancy. You also tend to have in a lot of those markets pretty low rents, um, which makes it hard to cover capex when it comes up out of the rent. I think that there seems to be, at least from some of the markets I've looked at lately, there seems to be a trend where many of them are not losing population anymore, or you could pick certain pockets that are doing better. I think one of the things that we've really started to see is there's more affordability there than in a lot of the rest of the country, and so you're starting to get people that are moving there or just staying there a little bit more than they were before, just because purely from a cost of living perspective. And I think some of these spots there's a lot going on to sort of revitalize the area, but I'm going to talk a little bit about the Quad Cities today. And so, what are those cities, right? It started off as 4 cities, although it looks like there's 5 now. On the border of Iowa and Illinois. You know, I'm probably going to mispronounce most of them, but it's Davenport, Bettendorf, Rock Island, East Moline, and Moline, or maybe Moline. I don't know. But it is, I think just Davenport or Davenport is on the Iowa side, and the rest are on the Illinois side. Um, but it's interesting because so even though they cross 2 states and different counties, there's a Quad Cities Chamber of Commerce. So, whenever I'm looking at a market as a whole and just trying to get my bearings, and that's really where I am with this. I love it when there's a Chamber of Commerce. I see what I can find there. I don't think I've brought that up in other videos, even though it's one that I like to do a lot. I think it's even more important in a spot like this where the data wasn't great as far as, when I look at Wikipedia, and I look at the market as a whole, it didn't have, it had the breakdown. You can see the metro area is growing, but it didn't have like the multi-year census data that you normally see. And I think it's because they're pulling it a little bit differently to fill this, where they're sort of maybe doing the math as part of this chart. But in any case, you can see um, really only one of the markets is growing, right? Or one of these 4 counties is growing that make up the metro area. These aren't the cities, right? These are the 4 metro, or these are the counties that are part of that metro area. But as a whole, they're growing, and they're really being um, carried up by Scott County, which I believe is where um, Davenport fits in. Yeah, and so it's one of the bigger ones in there. You'll see that it is growing, although it's not making this. It's not enough to create this whole number. So I'm not exactly sure There must be some suburbs too that are growing well, but the market, at least as a whole, is growing. It's not growing incredibly fast or anything, but it's better than a lot of them that we look at, that are shrinking, in that part of the country. And so looked at this, tried to get some insight there. Looked up the Chamber of Commerce, which I always love this. One of the things to keep in mind when you're looking at chamber websites is it's really their job to push this region, right? They're trying to grow business. And so, it's not that I don't trust the data, but I think that it's typically assembled in a way that's going to look like a sales pitch. Um, so they've got this total population 472. Let's see if that matches up with what do we have? Okay, pretty similar. So probably just a different time period, but pretty similar to what we've got here going on in the combined statistical area, right? I mean, we're almost identical. So I think that they're probably trying to cover that same locations, even though, sometimes when you have different groups of data, it will be, you actually see, okay, we've got more counties here, right? It's a 6 county area that they're talking about, where when we were talking about the quad cities, it's really just covering 4. So it's good to notice that and figure out, do I need to actually look in those other counties as well, right? But so it's not a huge metro, right? Less than 500,000 people, but it's big enough that I would be willing to look at a market like this, especially when there's a little bit of growth. If we can get, if the properties seem like they're really good deals, and it seems like there's, some opportunity, in which it does, just from, if you look at the yields on some of these, I mean, some are incredible, and I don't know that I necessarily believe you're going to hit these numbers. Some not quite so much, but it's enough that it makes me think, okay, if we have a okay market, but we have a great deal on an asset in that market, from a rent to price ratio, from relative to the price of, maybe we're just getting a discount on the property itself. Both of those things are going to make me a little bit more willing to pull the trigger. And so when I was looking at uh, the Quad City stats, one of the things I thought to do is sorted the population growth by city, and then look at, okay, where do we have properties that are available for sale that also match up with one of these towns. And this first one, Silvis, is the highest growing one that I've seen. And so that is this property here. Not a fantastic rental yield. And that's one of the things that you'll actually see in general is usually markets that have stronger growth will have worse rent to price ratios and therefore worse yields, because prices tend to move up faster than rents in markets like that. And so it's one of the things that happened where I am in San Antonio. When I first moved here, you could have really solid cash flow coming out of properties. Almost anything you bought, you could make it work, especially when rates were a little bit lower. But today, prices have just continued to move up really fast, and it's more difficult to find deals that make sense from just a pure yield perspective. The reason I'm in this market is because it's just such a good growth market, and so it's the goal is different, right? I'm not just trying to buy something, hold it, hope it keeps its value and spits out a bunch of cash. I'm trying to get one that I think is going to appreciate over time. Somebody's going to pay down the mortgage for me, and I'm going to have a great asset in a growing market in the future. That strategy's always worked really well for me. I've always made a lot more on appreciation of properties than on cash flow, but even when I've ventured into what I thought of more cash flow markets. But one of the benefits of investing in fractional real estate online is I get to go into other markets and just dabble a little bit, right? And that's what I've been doing. I've been buying these small pieces. I'm going to try to keep doing that. And so I think here, what am I doing? It seems like there's some decent potential to do that. And so I showed you that Silvis property. That is the only one in that market. So let's see. It's not a great yield. I did still take a look, and it is, that market's been growing for quite a long time. But one of the things is when you're starting with such a small population, I mean, we're talking about, less than 1,000 people growth since 2000. And so, even though on a percentage basis it's much stronger growth than the rest of the region, it really doesn't take much to make that happen. And so you don't necessarily expect it to have the same impact on prices as if your whole market is growing like that. And so, where that is maybe not the most attractive property from that perspective, um, I don't know, but it's one that I'll dig into because I think that, because this is the fastest growing market there. And so then, I got down to the next one, and it's Davenport, whichever it is. It's decent growth, not huge, but it's not shrinking. But it's one of the biggest population centers here, right? 101,000. Um, After the growth, yeah, they have these in the opposite way that you'd expect. But so this is just a good size or okay size market in its own right, right? Like, I mean, in general, I never have. I've tried to always avoid markets that are smaller than 100,000 people. Um, I think that this hits that criteria by itself. You don't even have to look at the MSA for it. So I like that about it. But one of the things you have to look out for is, when we look for stats for this city, it's obviously it's going to be a little bit more important to differentiate from one neighborhood to the next. Where when you have like the much smaller cities, um, you tend to have a little bit more homogeneous property prices. And so this is one I think I'm going to be really, digging into, and you can see, and obviously it's because it's a bigger city too. I think you can see, they have one, two, three, four there, and so I'll probably take a hard look at all of those. It is weird to have one such strong outlier, right, from a rent to price ratio as the other ones, and so we'll have to look at maybe why that is. And then the other one that I looked at as we got a little further down, let's see, is one that was available. So Moline, this is a shrinking one, but there is one of those right here, and this is the one that has just the um, craziest yield. I don't know where that's coming from. And for some reason, let's see, close that tab. Um, there we go. Open that back up. For so yeah, I mean, so that is it does have a shrinking population. It's decent size. It's unfortunate, right? But again, it sort of goes along with with what I was talking about. A lot of times when you have the shrinking markets just tend to end up with those higher yields. And it's just really funny how that works, or the higher rent to price ratios. But it's because the property values are typically moving faster than the rents in one direction or the other. So I'm not positive that's what's going on there. Although we will also look at. I closed it for both of these. I don't know why. Let's see. Is this it? There we go. Yeah. So you can see, like, okay, we actually had housing prices decline there. You can see this chart is it's relatively flat compared to, I'm going to show you, let's see, the Silvis one. You can see it's a little bit higher angled, although it is also bumpier. I find the smaller a market is, the more likely you're going to have these wild swings, and it's because you don't have just this huge volume. You don't have a really large sample to flatten it out. But then, like, we look at Davenport, you can see it's a little bit smoother, although I think you do have a little bit more of an upward trend there. Yeah, and you don't have such a pronounced downslope at the end, um, when you compare it to Moline. So, it seems like this market, just from the market, is not quite as interesting. And then, let's see, going a little further down. Oh yeah, Rock Island as well, right? And that's a bigger town at least, but it is also shrinking. Which, just like, it's actually pretty similar in size to Moline. It's a little bit smaller, but it's shrinking faster. And so then let's look at that one. Um, it actually seems like its prices are still holding up a little bit better. Oh yeah, actually, 1 year change up there. or Moline, we're down a tiny bit. Davenport, we're up, and Silvis, you're up, right? So, it doesn't hold perfectly, right? Like Rock Island actually had the strongest growth, even though it is one of the ones that's shrinking. So that's sort of interesting. But so what I did, so that's spent a lot more time, and I think if you're going to invest in any of these, you're going to want to do that too, right? You're going to want to really understand what's the economy that's driving the Quad Cities, right? I think that this is actually the chamber was probably the most, you know, gave me the most insight and color as to what that is. But the Wikipedia page was helpful too. You want to do some other Google searches, you can find all kinds of stuff out about this area. But I just want to really just focus on those things because those are the things that I'm always care about when I'm looking at the market, right? I want to look at like where the trends as far as property values, what are the trends as far as population growth, and I want to look at that on the longest term possible and think about it like compared to the other properties in the market. And then I'm going to just look at the properties themselves, right? And I started doing just a little bit of a spreadsheet to sort of compare them, right? I think probably what I'm going to end up doing is, figure out. So I think the most important or most attractive one is this Davenport or Davenport, whichever it is. I'm going to just stick with one now. Just quit saying whatever it is. And so, what I did, I looked at the price of the tokens, looked at why is this one adding a little different? Okay, that looks right. See if it changes it. Let's drag that down. I think I just did it the opposite way. So I took the current price of the tokens, multiplied it by all the tokens outstanding. And just in case that doesn't make sense to you, because this is the first one of my videos that you watched. When you buy these properties on Lofty, the little piece of the property that you get is referred to as a token because it's traded with a smart contract. It's cryptocurrency. It's more technical than I truly understand. But you can find, within their site, the total number of tokens, you multiply it by the current price that you'd have to pay for them. And that's how I get this total price. And so basically that means if you bought all the tokens, you'd pay this, whatever this dollar amount is for the property. And then I compared that. I went through and looked at what each one is renting for, right? And just put that in here. And so then I used that to just divided the rent by the total price to get a rent to price ratio. This math is what people typically do to find what they call 1% rural properties. You can see a whole bunch of these fit into that category. And so, that's just a general rule of thumb people use quite a bit. In my market, we're often, if a property is a 0.75%, there's a good chance that it's going to work if you get the right financing. It's new construction. That's going to be like where the best sort of cash flow deal is going to be here in San Antonio, but in other markets, people are often finding the 1% or even more. And you can see like here, you can see 1.88%. I mean, that's really high. It's because we're getting a big discount on this, right? Like this, if you look at the value of this property, it's significantly higher. If you just looked at it in a vacuum. I'm going to pull that one up just so you can see what I'm talking about. Now, I'm not going to go through each property today. I'll do, let me see, can I click back in here? You have to go into their old user interface to pull these up by market. As far as I could tell, there might be some way to do it that I wasn't aware of. But okay, so let's see. We're looking for 209 East. This one right here. And then tab. Way too many tabs open for this. I think you can probably already see that. But so, I looked at that price on 35. That's if you do a market order. So you probably end up, paying more than that with the slippage. And that's one of the things that we have to keep in mind if you're starting to buy a whole bunch of tokens. But I have to pick a price to analyze, and so that's where I am. So, okay, what is this home really worth, right? Like if we're looking at it not on the token basis, but like if we were looking for it out in the world. And let's just real quick uh, open that one in a new tab. Look at Zillow. Oh, Zillow thinks it's only worth 60,000, right? So that's not any sort of discount really from what we're looking at. Um, Not at all. So that's really interesting. Let's see if Redfin tells us anything different. Okay, see, Redfin thinks it's more, although it did sell for a couple of years ago for 65. All right. Um, and really the one I like to look at the most is homes.com. So let's see. And sometimes that one is a little weird for me. And I don't know why that is. It seems like it's in different markets, it works differently. I'm not sure. So let's see. Yeah, okay. Right here just spits out the estimate on this one, which is what this is the page that I like to see the most. In some markets, it seems like it brings up a different page, and I don't know. But okay, 65,000 on the low end to 106. Okay, so it looks like we're not really even, that's not really even a big discount. And so we're just getting a really healthy rent relative to that price there. And I mean, maybe we are, we're sort of on the bottom end of that range. But obviously, when this property sold at $50 a token, um, that had to be too high. Like they had to be paying too much for that. Um, and you can see, obviously, I dig in and look at like what's actually going on with the property. Why is that discount happening? But you can see from these tokens, a lot of them are, well, almost all of them are below 50, right? This one is still at 50, but there's not market trading. There's only limit orders, and so that just happens to be what somebody's looking for. Um, 703, yeah, I don't know. I mean, so this one's the only one that's actually above what people paid for, and everything else they've lost money. Um, I do have uh, I like to look at the ones that are discounted from their original price because it implies that like a lot of the um, somebody's already paid for the bad decision of paying too much for the property. And so I can come in and maybe get it at a better price. A lot of times it's because it's just, a lot of times it's just mispriced at the moment and it's because they're not collecting rent for one reason or another, or they're collecting rent, but it's not flowing through as cash flow yet. And so those are the things that, we'll go through and look at each one of these. And I think I'm going to just talk about a couple more things and then I'll stop for today because I am trying to not have these crazy long videos that I was doing at first. I notice I think people have a hard time getting all the way through them. And then that's not super useful, right? If you miss the end. So I'll go into each one of these individually. But I think, the way I'd approach this when I look at a market like this, first I'm going to pick, I really think Davenport's going to be the one that has the most opportunity. And so then in that market, I'm going to look at the ones with the highest rent to price ratios first. And I'll work my way down. If I like this one, I'll buy some of it and I'll go down to the next one and see. Um, there is one thing, and I'll have to dig into it a little bit more. But it appears the tenant of this property is a lofty investor, one that already owned some tokens in it and said, "Hey, I noticed it's for rent. I'm going to go and apply." And I haven't quite decided, excuse me, if I think that's a good thing or a bad thing yet. It really depends on their intentions, right? But I'll talk more about that when I get into that one. But that's what I'm going to do. I'm going to do that in the market that I think is the most attractive first, and then, well, obviously, I thought this Silvis was the most attractive, so I might look at that property. But I mean, it seems like it's just, I don't even think I'll take a look because it is. I'll look at the listing long enough to figure out, is there just something wrong with it, right? Like, do we have, is this a duplex? Should we have two rent times, or is that rent just way off, or that sort of thing. But beyond that, unless there's just some error in it, which I have found plenty of error, so it could be what's going on. But if it's not, I'll just have to quickly move on from that one. Because it's not such a great market that I would be willing to, like, not hardly have any yield in order to keep it up. But so yeah, starting next time, or we'll jump in, pull up individual properties. Because we've already talked about the market, I'll probably do a couple at a time. Figure out hopefully, if and then I guess what it really makes sense to do, and what I'll do is I'll probably go through a bunch at a time and then figure out, okay, do I like all of these in Davenport or just one or just a couple, and then spread out whatever I plan to invest across whichever ones I want to be in. And that's one of the things I think is important. Um, I don't think the right answer, and this isn't maybe it is the right answer for you, but I don't. The way I have been going about Lofty and investing in general is I don't necessarily think, especially in a platform like this where we have the ability to be widely diversified, I don't think it necessarily makes sense to go out and just try to pick the one property that's the best and say, okay, let me put all my eggs in that basket, right? Like in a situation like this, okay, yeah, maybe 209 East 13th has the best yield. It doesn't mean it's going to necessarily be the best performer across, over the long run. And so, what I want to do is try to rule out any of the ones that I think are going to be a real problem. I don't want to put any money in those, but of the ones that I think that are the lowest risk, I'm not gonna care, I'm not gonna worry too much about, okay, I'm gonna dump a lot more money in the one with a higher return than a lower return. Because I don't necessarily believe those return projections over time. Um, I think, if they're significantly different, it's one thing. But I think one of the things that they're not taking into account is like the level of discount we're getting on the property from one compared to the next. And so I think there's a little bit more to think about than that. And then, I'm just a big Howard Marks fan, right, of Oak Tree Capital, and he talks a lot about not trying to pick winners, right, but just trying to avoid losers and getting solid diversification. And it's not something you can necessarily do when you're buying individual properties out there in the world because you normally want to pick a market. You can't, I can't go out and buy 10 houses at a time. I've just been buying, but it is something, I've never tried to buy bigger and bigger properties. I've tried to buy more smaller ones, but I think that in a situation like this where I don't have to buy the whole thing, I can buy little pieces. It's a much, I think, safer strategy to try to spread it out a little bit. And then, you definitely diversification it's not free, right? Like you're giving up the ability to put all your money in the one that gives you the absolute highest return. But I don't necessarily think just based on our projections that we know which one that is, right? We can tell which one it looks like it's going to be. But for example, it can, one of those properties can have um, one bad tenant, have a big capex item, some higher repairs and maintenance for one reason or another, and it can turn out to be significantly worse. I mean, we're just looking at the rents relative to the prices. You could have longer vacancies or whatnot, and so I'm not so focused on what that exact number is that my return is. I'm a lot more focused on, okay, is this an investment? Do I think the property is going to do well long term? Is it are there reasons? Is it in a flood zone? Does it look like it's in a neighborhood that's going to scare tenants away? Lots of graffiti or signs that like stuff is just broken or abandoned. I'm trying to avoid a lot of the risk factors, but not necessarily filtering too much based on exactly what it says the yield is, provided that just in general it looks like it's a significantly high enough yield that I'm going to be happy with it, which almost everything on the platform is. And so it's more a matter of picking properties that I believe the story, that it's going to actually spit out that cash flow than it is actually just like comparing one cash flow to the next. And I think if you go back and you look at the people that have really lost money, because we've talked to quite a few now, people that have bought in at 50 and now they have a $37 token or something like that. A lot of times it really was they were just looking at, well, what does the yield say, right? Like what's that, and not really thinking about excuse me, not really thinking about all the other issues that could that go into whether or not a property is a good investment or not. And so anyway, as we go through these, I'll try to do the same thing that I have been, and just share a little bit of info as far as like what I'm doing as far as due diligence, I'm looking at them, how I'm feeling comfortable about is the rent that they're charging, is that actually market rent? Is the property priced fairly relative to, hopefully we're getting a discount. Um, it's not always going to be the case, but a lot of times on here we're able to, um, this token price multiplied by all the tokens. A lot of times this price is cheaper than what you'd go buy the property for. And even though it didn't look like this was much cheaper, um, it looks like it's at least on the bottom end of the range, which is nice, for a property that's already operating. In any case, I think that's everything we're going to go over today. Next time when we come back, I'll just jump into individual properties. I think we'll try to go through all four of the Davenport ones because those are the ones I'm the most interested in. Like I said, I already want to maybe just really quickly jump into Silvis and then uh, and then we'll go from there. But in any case, until next time, I'm going to keep making mistakes so that you don't have to.